Good morning, traders. This is Joanne with Succeed in Forex. Welcome to our Forex Market News broadcast for Tuesday, February the 26th, 2008. Headlines out of Switzerland this morning read, "The yen fell against major currencies on rising risk appetite, and investors return in carry trades." The yen fell broadly on Monday as euphoria over the U.S. bond insurance sector boosted the appeal of stocks and other risky assets, hoping to underpin high-yielding currencies such as the New Zealand dollar. Standard & Poor's said it had removed MBIA Corporation's top AAA rating, and added that the outlook was negative, suggesting that a rating downgrade remained likely over the next 2 years. That announcement came on the heels of news of a possible rescue plan for the troubled Ambac Financial Group, the second-largest U.S. bond insurer. Such a step would limit the damage from ongoing credit crisis that has lessened investors' confidence. Dresdner Bank, part of the Insurance Alliance, on Monday said it intended to support a rescue package for Ambac. The dollar-yen raced to a session high of 108.22 before retreating in late trade to around 108.09, but it was still up approximately 87%. The euro-yen jumped to a 5-week high of 160.41 and last was trading up around 160.30. The euro-dollar was little changed at 148.32. It seemed to be taking a breather after hitting a 3-week peak at 148.63 on Friday. Global stocks have gained overall on hopes of the Ambac bailout. Ambac, which insures municipal bonds as well as other forms of debt, is facing billions of dollars of unexpected losses from guaranteeing repackaged risky subprime mortgages. A bailout could see Ambac avoiding a rating downgrade that would force investors to sell billions of dollars worth of securities, which would lift borrowing costs for consumers and U.S. city governments and further put a strain on an already slowing economy. The New Zealand dollar, which has the highest interest rates among industrialized countries at 8.25, rose to levels not seen since it was floated 23 years ago. The New Zealand dollar hit 81.52 today, from yesterday's close of 81.38, which was up 62%. Kiwi yen advanced to 87.95, but the dollar loonie fell to 99.54. The Australian dollar and sterling also posted gains against the Japanese currency. The Australian yen rose to 130, while the pound yen climbed to 212.54, but is now trading around 212.33. The yen often suffers in times of rising risk appetite because investors borrow it at low Japanese interest rates to fund carry trades that invest in higher-yielding currencies. During the Asian session, the Australian dollar bucked the trend. The Australian dollar was able to buck the trend, heading higher, almost touching the psychological level of 9,300. The Australian dollar has been supported by the prospects of continued RBA rate hikes, which are fueled by inflation pressures and caused by the recent surge in investments in mining industry. Barring a sudden shift in risk appetite or in commodity prices, the Australian dollar should continue to outperform. Yesterday, Trichet continued to hold onto the theory that the EM countries will support Europe's slowing growth, stating, and I quote, "To which extent a possible slowing down in some mature economies might actually be partially offset by stronger growth in other regions." Late last night, SBN's Roth commented that the SBN is uncomfortable with recent price increases, which have risen significantly, while all the time doubts over the economic outlook have continued to grow. The rise in inflation within Switzerland is indicative of price pressures in the midst of a slowing economic activity across Europe. While inflation is still expected to stay below the SBN prediction of 2% target, there is increasing probability that price pressures will push that figure above the 1.7 forecasted. Today was another light economic calendar for Europe. The German IFO had the market's attention in the European session today. While the figures were expected to fall slightly compared to the U.S. recent collapse, the numbers were actually positive for the euro, coming in at 104.1. The first reading of the UK February retail sales will be supplied today in the CBI Distributive Trade Survey. This will be the first sign if January was an anomaly or part of a larger downtrend. The number actually did come in at a -3. The market had been expected to rebound slightly, which would have supported the pound. In the European session, the IFO gave the euro a boost. The dollar continued to come under pressure in the European session as the IFO beat expectations. The dollar is clearly bearing the brunt of the market's bearish sentiments, especially given the number of economists jumping on the recession bandwagon. 45% of the economists that were polled believe the U.S. is heading into a recession, which is a jump up from the 20% in November. Adding fuel to the fire came the sobering comments from Greenspan, who was in Saudi Arabia. He said, and I quote, "As of right now, U.S. economic growth is at 0, and recovery might take longer to emerge than it usually does." Unquote. On the continent, the German IFO was slightly softer, but better than the market expected, which gave the euro a decent boost. But not all the news was good, with forward-looking expectations sliding down. The fourth quarter GDP slowed to 1.1%, showing private consumption was actually negative. However, given the doom and gloom coming out of the U.S., these mixed figures were supportive of the euro and should continue to be. That concludes our Forex Market News broadcast for today. Hope it is helpful in your trading, and we'd like to thank you for viewing. Hope you'll be able to join us tomorrow. Before we sign off, we would like to invite you to visit our website at www.succeedinforex.com. There you will find some information about our Traders Trading Center, where our motto is Traders Helping Traders Succeed in Forex. And also you will find a link to our Yahoo forum, which is also called Succeed in Forex. Have a great trading day, make lots of pips, and we look forward to seeing you tomorrow.